Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Hey, good morning, everybody. Welcome to the next episode of Financially Fluent. Very happy today to have a guest on our show, Holly Geerdes. Welcome.
Thank you, Ray. I'm excited to be here today.
Awesome. So, you and I run into the same thing a lot of times. It's just we have different areas of specialty, and I've gotten to know you over the years. And so I thought it might be a good idea to just kind of bring up some topics that we hear spoken of very commonly, right? And so one of those is just probate, right? So if you wouldn't mind, maybe just share a little bit about, what is probate like? And then how do you avoid probate?
Yeah, probate, I feel like, is one of the biggest misconceptions with people in the United States. They assume that when you have a will, that avoids probate, and it does not. Probate is just the government legal process that people have to go through when a family member passes away. And what the legal process involves is to get clear title on certain assets like vehicles, real estate, companies, and any accounts, or as you know, life insurance, where they forget to put a beneficiary. So the probate process can range from 1 to 2 years. And the average cost can go as high as 5 to 15, 20% of the value of the assets. So when you don't get a trust, or when you just have a will or nothing at all, the probate process is the only entity jurisdiction over those types of assets. And again, most people think that they can avoid probate with just a will, but that is not true.
And the thing is, some people, they don't have a will, they don't have a trust, they don't have anything. So when I run into those situations, I'm at least doing my part, if you will, on, well, what do you have? Is there life insurance? Let's make sure those beneficiaries are updated. Are there contingent beneficiaries, and make sure we have identifiable information on the beneficiaries. And same can be said with, IRAs and 401k type of accounts. But, I guess one of the thoughts are, when would it make sense, at least in my view, it always makes sense to have something, right? A will or a trust. So how do people determine whether they should have a will or should have a trust?
Well, it's really, Ray, a personal decision. And what I love about you, Ray, is that as a financial planner and professional, you know more than the typical financial planner because you take a holistic approach. You want to make sure that the family is taken care of in all aspects regarding their assets and legacy planning, if that's their wish. So again, whether they need just a will, everybody needs at a minimum a will. That's a personal decision, and it requires a financial planner and attorneys to look at all their assets and determine what assets can we avoid probate. And as you just stated, Ray, because you know more than most financial planners, you know that it is very important to designate a primary beneficiary. And that's not even enough, because eventually that primary beneficiary may pass away before you, especially between husband and wife. And so you also need a contingent beneficiary. And typically probate gets involved because the primary beneficiary passed away and they didn't have a contingent beneficiary because they didn't have financial planners that always take a holistic approach and make sure all the T's are crossed and all the I's are dotted. And so, when we typically work together with financial planners like you, we go through the assets and say, here is these assets that as long as you designate a primary contingent beneficiary, that can bypass probate. We may not need to do the trust for those. But then you typically have a firm. Some people have companies that they put real estate in, or they have a business. There's no way to designate a beneficiary for those types of assets. And there's no way to pass clear title to those assets, including vehicles. You only have two options: probate court or trust. Those are the only two mechanisms right now to clear title after somebody dies to pass it to the next person.
Yeah. And, a lot of times what will happen is I'll talk with folks and they hear the word trust and they're thinking, well, I don't really have enough to, need a trust. Or, they may think, they can't afford it, something like that. Those are some of the things I hear. And I hear the other extreme too, which is, ooh, I want to get a trust because I'm going to save on taxes. So where might be people be a little more myth than facts on that kind of conversation?
Yeah, another misconception, Ray, that you pointed out is people think that the trust is for the super uber rich people. And the vast majority of people are not super uber rich. So again, most people getting a trust, the primary reason is to avoid probate. They don't want to subject their family to 1 to 2 years of freezing the assets before it can pass on to their family at their death. They don't want to have expenses related to probate, which can range again up to 5 to 15, 20% of the value of your assets. Why do we have to pay that when we can get it way cheaper than the cost of probate and not have our assets frozen? So the vast majority of people is your run of the mill people that own typically a house, people that start their family with minor children. Because in a will, you can designate a guardian who has physical custody. But unfortunately, that has nothing to do with the assets that you're leaving behind for your children. If you don't designate who's going to control that during your minor children's lifetime, then the default is always probate. So there's many reasons people get a trust, and it's not about how much assets they have. It's really, do I want to subject my home to probate? Do I want to make sure my children, the assets that I leave them, is protected and taken care of? And in our world, there's trust to make sure that long-term care issues are addressed, which, you are one of the foremost experts in that. And plus also families want to protect the assets for legacy. They work really hard their whole life and then they pass it to the children and then the children get divorced. Children get sued. Children are bad with money. They have drug problems. They have depression, bipolar disorder. So families will do a trust to protect the trust for their children under those circumstances. So there are so many reasons people get a trust. And most of it is not because they're super uber rich. They just want to make sure that they protect what they have based on whatever their concerns are and whatever their wishes and wants are.
And that's what's interesting. We're using the word trust, but the reality is there's so many different types of trust. And so I think sometimes you meet people and they think, well, I don't want to do a trust because I don't want to lose control. So that's one of the things we hear. And so I thought maybe you could speak to that a little bit as far as maybe let's get into a little bit of what's the difference between a revocable, living trust. What about an ILIT? What are we protecting assets? There's lots of different types of trusts. So I don't know if we get into CRT or not, but charitable remain trust is another one. So if you don't mind, maybe just kind of get into a couple of those and explain the differences to our audience.
Yeah, right. We have a lot of fun, don't we, with our lives? Because we are familiar with and aware of and knowledgeable about that there are many different types of trusts for different purpose. The most popular trust, the revocable, as you know, the owner of the trust retains control. There is no losing control or restrictions. You carry on business as usual when you put your assets in a revocable trust. There's no change. Your tax ID is the same social security number, no separate tax return, no tax triggering event. You can put anything with debt in it without having to get permission from the lender because you and the revocable trust are one and the same. And so that is the most popular trust for that reason. And so families will do the revocable trust to give it outright to their family upon their passing without probate. And some will do more advanced revocable where we don't just want to avoid probate. We want to make sure after we pass away and we give all these assets to our children that they're not going to have to give it away if they get divorced or sued. And if my spouse remarries, I don't want my children disinherited. And for financial products that you specialize in, like life insurance, retirement accounts, investment accounts, CDs, mutual funds, all the wonderful products that you carry and help your clients obtain for building their wealth and their net worth. Those are also assets that many parents don't want to give outright. They want that also to pass through the trust at their death, protected in case their children again get divorced or sued or their spouse remarries. So the revocable is very versatile. It's the most popular trust. It's the most flexible. You can even terminate it and change it for whatever reason during your lifetime. It really springs into action upon your death.
Right.
During your life, it doesn't change anything whatsoever. The irrevocable that you and I are familiar with is usually for estate tax avoidance, right? So when you talk about the ILIT, which is an irrevocable life insurance trust, when you help your clients get life insurance for long-term care protection, for passing on more wealth than they could ever acquire on their own.
Right.
And life insurance is also used for, asset protection because they're very hard to break into, and also, build cash value for investments. I learned all this from you, right? Right. So most people, we always make sure that as part of their portfolio, they should have a life insurance for those reasons. And the ILIT itself makes sure that the death benefit is not included in the owner's estate,
right?
For estate tax purposes, because if you pass away with a certain threshold of assets, you could be subject to 40% estate tax.
Right.
So the life insurance itself, if you can put that in the irrevocable life insurance trust, which is fairly cheap compared to having to pay 40% estate tax. Because a lot of times life insurance is what triggers that. It took them over the cliff. Mm-hmm. And so putting that in an ILIT will ensure that they can avoid triggering that 40% estate tax. And the ILIT, you can pass the death benefit, which could be $1,500,000, $2 million on up. You want to make sure you give that amount of money protected. And you could do that in the ILIT for your spouse and your children. So again, the ILIT is very popular for life insurance significant death benefit that you want to pass without triggering that taxes. But there are other irrevocable trusts that's not used for estate tax avoidance.
Right.
And those are for protection from lawsuits and other areas. But we could go on and on for hours, Ray.
Right.
With all the different types of trusts that you and I have done together with clients.
Yeah. And people will say, well, I don't need to worry about that. My estate isn't that big. They're looking at the tax code today. Of course, that's based upon a 2017, law, which isn't that long ago. And it's, you're supposed to sunset the end of this year. And then I think people thought with the election back in November that would just continue on. And there's a good chance it will. But at the end of the day, there needs to be legislation to make that happen. So it's very possible that it does sunset. And so it's just kind of a reminder that, some of these strategies, you need to look at it over the long term and not worry about, what's the current tax code, because those, as we know, change all the time. Tax brackets, tax rates, what an exemption level is. So appreciate you kind of explaining that. There's something else that's kind of dear to my heart, and both for people that work at our firm as well as some clients. And that's, we have parents that have special needs kids. So I think it might be good if you wouldn't mind just elaborate a little bit on what a special needs trust is and what are some things that people might think they're doing correctly, or maybe they're doing it, but could be improved.
Yeah, I think obviously when you have special needs children that eventually become adults and you're not going to be there for them forever, it is absolutely critical to do proper trust planning. And there are two ways to do it. One is to establish a special needs trust while you're alive. That's the old school way. It's not necessary. If you're already taking care of your kids, you don't want to fund the trust and put it in there and it's irrevocably in there and you have to file tax returns. Those are really only for when you have like a personal injury, medical malpractice, and minor child receives a settlement. And then you do have to put it in a special needs trust where court and everybody else oversees that to make sure it's in the best interest of the child. For a vast majority of parents, that's not how, the disability happened for their child. They take care of them. They didn't get no big lump settlement. There was no lawsuit. And I'm talking about autism and those kind of things. And the parents then don't need to create, in my view, a special needs trust while they're alive. What they need to do is do their own trust. And upon their death, whatever portion or percentage they're giving to the special needs child will automatically go into a subtrust that's already set forth in their own trust that will make sure that they're taken care of. They can apply for government benefits. They can maintain whatever government benefits they have. And they've appointed a trusted family member, a succession, that will make sure that after their death, their child, who will eventually become an adult, will not have to fend for themselves or have people take advantage of them because they have assets. And so, again, there's two different ways. And I think the third piece that's most critical is working with a financial planner like you that makes sure that when they pass away, that trust is funded for the lifetime of the child and not leaving them when we don't know what's going to happen to them. Will they have enough to live on? Will they have enough to deal with their health care and whatever needs, or I should say maintain their standard of living? And so the third piece, and probably the first step they need to do, is make sure that they have enough assets to give to their child to maintain their standard of living of how they took care of their special needs child. Just letting the dice roll and see what happens is terrible for special needs children. That absolutely requires careful planning, financial planning first.
Yeah.
And then making sure that those funds upon their passing will go to the special needs child. The one thing that I have seen parents make mistakes is, don't leave anything for them. Oh my gosh. They're like, well, we want to make sure they can get government benefits and maintain. And that's not enough. That's barely enough for survival. So I've seen parents that come in here and their initial thought was, we have 4 children. It's going to go to the 3 children equally, and then they'll take care of the special needs child. And we don't want to leave anything to them. That's horrible planning. Horrible. So that's my professional opinion on that.
I like that. You got their opinions. And sticking with the health theme, this is where we're probably going to do a little more back and forth. People, when they hear long-term care, all of a sudden, people usually have some kind of emotional reaction to that phrase. So I don't like that phrase as much as, say, aging, because that's something that we're all dealing with. Either we're dealing with it personally, our spouses or significant others, our parents. And so when you think about aging, it's just, I think there's an educational gap out there. And a lot of times people that I will meet, and they'll just say, well, I'm just going to let, I'll just let Medicare, Medicaid, they don't even know the difference, right? That'll take care of me. That's kind of my plan. And so, kind of speak to when that actually might be a strategy, but also where that might be not the right strategy for folks.
Well, for long-term care, and as you call it, aging process, I call it asset protection, because Medicare does not pay for long-term care.
Right.
They maybe pay for 100 days max, and even then they don't do that because there are some complicated rules for Medicare to even give you anywhere near 100 days for home care or at the nursing home. And so what I find, the generation before us, they didn't have access to information that we have. And so what they were left with is nothing at all, or they had the standalone policies from their employer. And as you stated, the aging process, what that results in is the premium doubling, tripling, quadrupling to the point that they can't afford it. But they've been paying on it for 30 plus years. The premiums were low, and a lot of them went bankrupt.
Right.
So it was very hard. It's not sustainable. So, the life insurance with the long-term care rider came in. You obviously know more strategies beyond just using the life insurance. There's different ways to do that. But what I do find in my world, because everybody comes to my office saying they want some level of asset protection. and even avoiding probate. When I consider asset protection, that means trying to save as much as your wealth, your money, your assets to pass to the next generation. But the vast majority have no long-term care planning. They have a beautiful retirement portfolio. They're very proud of it.
Right.
They've got, a large 401k IRA, they've got real estate, but those are all taxable, as you know. And when the long-term care cost hits, all of a sudden your beautiful retirement portfolio implodes. And the cost is so astronomical, your retirement assets can't keep up. Barely for one of you, let alone the two of you as husband and wife. And so regarding the long-term care planning, I always tell my clients, this is great. You've got 2 million, 3 million, 4 million, 5 million. Have you talked to your financial planner to do a stress test? What is this going to look like when it's under stress, when you are now, having long-term care disability costs that Medicare doesn't pay for?
Right.
Right. And if you have long-term care disability for 5, 10, 15 years, how much of your assets are going to be left? How much taxes are you going to have to pay?
Right.
And so, people, when I say that, they're like, you know what? I never thought of that. I just assumed that this was just going to look perfect till I die. And it's not. 70% of Americans before they die will face a long-term care disability event. 70%. The biggest, and I'm an attorney, the biggest bankruptcy now is due to long-term care disability costs, medical. And in bankruptcy, you could owe somebody $1 billion and you can go to bankruptcy and get it all forgiven, but they will not forgive medical or long-term care related expenses. So it is an absolute crisis in the United States. Medicaid is unsustainable, especially with the baby boomers, and a lot of elderly people are going broke. The largest homeless population is women, seniors. They outlived their husband, took care of them, and they're having disability costs. They can't work anymore. They didn't do any financial or long-term care planning. And so the largest population of homelessness is women, seniors, after their spouse died, or maybe they weren't married or widowed, but it's a financial crisis in the United States. And I always appreciate financial planners like you, again, doing holistic,
Right.
not just trying to get the biggest interest rate return,
Right.
but also looking at what is this going to look like when you when you're retired, when you high probably will have some disability event just due to aging, and Medicare doesn't cover that. How are we going to cover that to make sure that you can maintain your standard of living and still hopefully stay at home rather than push to the nursing home?
Right.
And those costs are astronomical also.
Right. Yeah. So that's where, for me, when we meet with people, it's such a high probability, especially if the people are married, especially that the odds of one of the two needing care in their lifetime is really high. So it wouldn't be right for me to ignore that statistic, if you will. And so then it's about planning. And so from a planning perspective, you need to think it through. And so then we're just exploring it in different ways, right? To be able to, quote, fund something that may happen down the road. When it comes to us living and dying, right? Everybody knows that we have an expiration date. So, but that gets back to the planning also from a longevity standpoint, right? We don't know how long we're going to live. So that's a big unknown. We also don't know, are we going to have long-term care needs? When would that happen? Well, the statistics say, I want to be in my 80s. Well, what if it happens in your 60s? What if it happens in your 90s?
And now, a quick message from today's sponsor. If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
So getting back to what you were saying earlier, it's, well, how can I plan for the assets I have and the income coming in? How can we plan for it? And for some people, so I want to go ahead and just talk about that elephant in the room. Long-term care policies, those standalone policies, when they first started, they just didn't have all of the information. They were not able to price those correctly. And so a lot of those policies got a bad name. And there's usually a winner and a loser. Sometimes a policyholder won. I can remember the time kind of when I first got into this industry, I would shadow meetings from a couple of partners that the firm I was at, and I was grateful for it. I was able to learn very quickly. I can still remember there was a daughter and her two parents coming in. One of the parents was in a wheelchair, physical limitations. The other one had some Alzheimer's. And then there's a daughter you could tell was very stressed. But fortunately for her, the financial advisor that was in that room, like I say, he's well retired now, he wrote a long-term care policy. The company happens to stay in business with inflation rider. And he told the daughter how much money that was going to be able to come for both of her parents' benefit. And she was in tears on just the relief.
Wow.
And so, that's a great story. But then there's many other stories where
the majority
of the time, though, it's the other way, which is now the premiums have gone up and you have to make the decision, oh, you know what? I think I'll just get a reduction in benefit, or I can't do it anymore. I put all that money in there and now I have nothing to show for it. So fortunately, the industry kind of got together and there's these hybrid ways of doing it. Not that that's what somebody should always go to, but it's an option for people to explore. And to give a kind of an easy example to understand is, what if somebody had a $500,000 life insurance policy? So we know if somebody were to die, right, that's $500,000 of tax-free benefit to their beneficiaries. But what if you could access that death benefit while you're alive for care needs up to $10,000 a month? Meaningful. And so
game changer.
Game changer, yeah.
For the whole family, extended family.
Yeah. And you know how much you're putting in, right? You can proactively determine, you know what, I want to pay this over a 5-year period, a 10-year period, or as long as I'm alive, I got this pension, I'm just going to pay it.
Yeah.
Right. And so, and then if I never needed it, at least there's a benefit there. So that's pretty popular. Basically, in that situation, people are trading dollars, right? I'm going to put in $1 in today to hopefully get $2, $3, or $4 per dollar out later. Obviously, there's underwriting there. So that's the unfortunate piece of that plan is if someone, waits too late in the game and their health has changed dramatically, they might not be insurable. So now we got to go different routes from a planning perspective. And so now we got to dedicate assets usually, and that's not going to be as tax efficient. And I don't want to say that all long-term care only plans are bad. They're not. The newer ones that are out there now, sometimes that makes the most sense for covering that risk, especially if someone's older and a business owner, the tax deductibility of those might make some sense. So, those are still out there. They've been improved. So it's definitely a topic, you may have sensed I'm a little bit passionate about because you want to at least have a plan. So appreciate, you speaking to that as well.
Well, I mean, that's why I'm a fan of yours, because you're not just a one-trick pony. Most financial planners in the long-term care field, I find that they just sell them one thing. And that's just not appropriate. Everyone's different. Everyone is different at how much they're willing to invest or can afford and their longevity. So, when you meet with clients, you always go over all the different options and make sure it's appropriate.
Right.
But the other thing I wanted to ask you about is, what about those policies where they insure both husband and wife? And is that because one of them is harder to insure? What are those types of policies? Because I've seen some of my clients that come in with those where it's one policy and they're insured under that one policy. Explain what that is.
Right.
What's the purpose of it and what's the benefit and downside?
Right. Yeah. So when I'm talking with people, I just try to get somebody to a comfort level where they can be as open as possible. What do you really want? What are you really concerned about? And as long as somebody's more open, we can develop solutions, because I'm not, I'm agnostic to any particular, I don't work for a bank, I don't work for an insurance company, right? And so when you're talking about those kind of policies, those can be attractive to situations where they just want to be covered. And because sometimes there's a lot of details here. So the devil's in the details, right? But each policy is different. So some of them might be where each person has a bucket, but it's part of one policy. But there's other ones where they have a shared bucket, if you will, And if one person ends up needing the whole bucket, that ends up, that's what happens. And then the bucket is eventually dry. But from a planning perspective, that's not necessarily a bad thing. So it really gets into kind of pricing. And I've seen situations where maybe their healths are vastly different, and that may not be the best solution. It might be better for them both to have one, or they do have one, right? And I've seen cases where one spouse is uninsurable. And so sometimes that couple might say, well, I guess we're just not going to do it. And I would say, don't do that. If one of you is insurable and the other isn't, go ahead and have the insurable person, get it if you want it. So you can at least reduce your risk in half. And here's the big takeaway when you're doing this. Once that bucket is set aside, I've checked that off, whether you've checked it off with one premium payment, even though you have more premium payments to come in the future, but that big bucket's there, right? Once you get that thing started, the big bucket is there. And when you think about your plan, it frees you up on your entire financial plan. So you don't necessarily need to sit on cash for too long, right? If you have too much cash sitting for way too long a period, you're probably not even keeping up with inflation, right? Or maybe your overall investment philosophy, you may be a little more conservative, a little moderate, with your portfolio, because you're worried in the back of my mind, well, what if this happens? But once you got that bucket checked off, now you've kind of freed yourself up. And I think too, from a psychological standpoint, you're going to sleep better at night knowing you've, quote, prepaid, or at least address that risk, up front. And so the big, peace of mind there is you get to just enjoy life more. And I want to say one more thing about it is, if you have something paid for, and then something comes up, you're probably going to be the first one to, hey, my benefit, right? Like imagine, you paid your house off, and you didn't have a homeowner insurance policy. And then your spouse probably kicked you, said, you better get some homeowner insurance on this house, right? And then all of a sudden you get a big, $30,000 claim. You're going to be fast to go get your claim. So same thing. If you have a policy in place, you're going to be quick to address that need, versus if you have nothing in place, you're probably going to delay that as long as you can. And the other thing to think about on this is activities of daily living is how it's determined most of the time. So you can't conform to the 6 activities of daily living. We'll put that in the show notes. And or here's the other thing: what if you're cognitively impaired? Well, that could be, there may not be any really physical deterioration yet, but that one just being, cognitively impaired, you got Alzheimer's, something along those lines, dementia, that could be a qualifying reason to be able to access the benefit.
Does long-term care policies cover cognitive disability when you can do all 6 ADLs, but you're just cognitively impaired? Or do you have to add that or make sure that the policy?
We want to look at the policy, right? So there are differences among these different carriers, right? So you do want to ask I think you need to ask that question of whoever the agent is that's helping with that. You just want to make sure. I think that's a piece that should be in there. That should be the qualifying reason, because most of the studies are going to show if somebody has that going on, it's only a matter of time before the physical limitations will follow.
And Ray, you mentioned just right before that, and the key word is peace of mind.
Mm-hmm.
My clients that are smart enough and they want to make sure that they prepare for whatever could happen.
Right.
And therefore, they no longer have to fear what could happen or the unknown. And that's the whole point of long-term care planning, financial planning, establishing your trust, is to make sure that no matter what happens, you're prepared. And therefore, you never have to fear, like a lot of people, as they get older, the fear gets more exacerbated as they start aging and becoming disabled, and the cost, and of course, the inflation that always comes with that. So I like that you said that, because that's really the whole goal of all of this, both in your field and my field.
Right.
The other thing that I wanted to touch upon that most financial planners don't, I don't know most, but my experience with my clients, they were never told when they got their long-term care policy the difference between reimbursement versus what's the other one they said?
Indemnity.
Indemnity.
Yeah.
Yeah. And so what do you tell clients about that? What's your preference on policies that do reimbursement versus indemnity? I just think that that's not discussed.
Right. No,
And you find out
yeah.
when you need it.
Yeah. And that's the thing is asking questions, I think is what folks need to do. Anything that you're doing should always have a good understanding of it. You're never going to understand it to the nth degree, but you want to have a basic understanding and ask questions. And you may want to know how long somebody's done that. So when you think about receipts based,
People would not ask that question. How would you know?
well, I think as an industry or a leader, we just need to do a better job of educating, right? Whether it's through podcasts or things that are on, online. Unfortunately, though, TikTok and things like that, there's a lot of things that are out there that's noise and are done by people that aren't even licensed, right? They're not even professionals. So I know that can be a little confusing, but to kind of answer that first question. So indemnity, right, would mean, okay, now I can't do 2 of the 6 activities of daily living. Now I qualify for the benefit and I'm not having the full with receipts. I have my doctor note and the policy, is going to pay my benefit. Now, I'm not going to say that that's better necessarily, but that's how that works. Receipts based is what you think it is, right? It's receipts based and each carrier has their own way of doing things. So you want to know, what's the process? Do I have a dedicated team that's really kind of a helpful spirit on processing these claims, from a receipt standpoint? Then that may be okay. So one's not necessarily better than the other, but they are different. When you want to go receipts based, might be if you don't have a person you really trust to help with that. Maybe there's especially if there's any kind of cognitive impairment, you may want to have a little extra layer of that going on. But a lot of people would say, I don't want to fool with the receipts, and I got my own family member taking care of me, and I'd really like to, reimburse my family member a little bit. And so if that's the case, you do need to make sure that, I'm assuming they're not licensed, right? Caregiver, if you will. So you do want to make sure that you have an indemnity one and not one that's receipts based, if that's your situation.
And the receipt basis, you pay out of pocket, have proof, right, of what you pay, or then the insurance company ensures that it's covered and they reimburse you.
Right. Yeah. That's that's going to be the case most of the time. And you just want to make sure with that carrier, well, who does that caregiver need to be? Do they need to be licensed in my state? That's common, but you just want to make sure it's not, because there's always new stuff that happens. Like, so you have one that says, well, you got to use the select list of people. I would be a little less inclined to probably recommend that.
And what's the typical rule for, can you have family members that are not licensed to take care of you and they can't work? So, because another financial crisis is caregivers, right? They have to take time off. They lose that income.
That's right.
They lose the ability to move up in their career. And I don't know what the statistic is, but it's billions of dollars of lost income by caregivers, not to mention their health and mental health starts to deteriorate because it is just one of the most difficult things you can imagine of having to take care of your spouse, your parents, or however that plays out. But those receipt-based, do they even allow family members to take?
Right. Yeah, they're probably not going to. And so the ones that would have what's called a chronic illness rider, most of those will allow that to happen so that you could, reimburse your family member. Now, most family members, they don't necessarily want it, and most family don't ask for it, but a lot of them would appreciate it. And so I think that's a reason that that policy might be more attractive. Now, understand if something has a chronic illness rider versus a long-term care rider, there are tax deduction differences, right? So something that's, in the tax code is long-term care policy or long-term care rider, there will be some, sometimes it's small, sometimes it's not small, but tax deduction, or the chronic illness doesn't have that, but they all are going to give you the tax-free benefit on the back end. So that's always an important factor when you're thinking about, well, how much do I need? Think in the terms of this is, tax-free benefit versus doing some calculation of, oh, I'm taking this from my taxable account, I'm taking this from my IRA. If you got, $2 million in your IRA, and it's pre-tax, you don't have $2 million in your IRA. You have some, And I'm going to say I'm out of some, right? So that's where, the tax-free benefit can be something to just kind of remember.
Well, so when you do start taking the benefits, and this is a tax question, our favorite Uncle Sam, right? And most people ask the question, well, is this taxable when I start taking essentially from the death benefit, accelerated from my long-term care versus my investment accounts, term accounts that some people are forced to liquidate because they don't have long-term care planning or long-term care policy. Obviously, those are taxable, but so how is it taxed, if at all, when you have the long-term care type of policies that you're talking about, where you can use a death benefit during your life for your long-term care? How does the tax?
That's kind of the beauty part, right? Is you're probably going to get that benefit, and it should be tax-free. So that's again one of the strengths of having something like that in place. And from a planning standpoint, let's say somebody did have a life insurance policy with a chronic illness rider, and things are happening. There's not a broad statement, everybody should do this, right? You just have to really get into the weeds a little bit, be a little surgical when you're looking at different assets, because sometimes you might be able to pull a little bit out of your IRA each year. You got to look at your situation, your standard deductions and that type of thing. And so sometimes what I've seen people do is they take it out of 2 or 3 different types of account to solve it, right? Because when people are retired, it's very different when you're taking money out of accounts versus when you're just working and you're putting money in a 401k. That's a whole different mentality. And it takes a lot of people a mental adjustment to when they get retired. What bucket should I be taking out of when I want to go do this? It's always fun to take money out for fun, right? But what about the time they take out money that's not fun? You still need the advice and recommendations on what the right bucket to pull from. And that gets back to just the planning on, an ideal kind of plan has money in different types of buckets, right? They each have a purpose. Too many times what I've seen is folks have money heavily in pre-tax accounts, and they really don't have a whole lot in other types of accounts. And so from a tax standpoint, that doesn't give you enough chest moves, in my opinion, for when, life happens and you're trying to, like say, do something in a particular year. If you have different types of buckets now, you can be a little more strategic from a long-term planning's perspective, but each year now we can be tactically, getting the best juice we can that year. Yeah. If you do that year over year over year, all you've done is just freed up more dollars for you to enjoy or pass on or give.
And maybe this will be the last piece on long-term care, but I'll tell you my first introduction, even though I'm a estate planning lawyer and I do trust, long-term care and financial planning is not in my wheelhouse at all. Right. And so my first introduction to long-term care planning was probably 17, 18 years ago. My New York client, husband and wife, they both had a family history of cancer, heart disease. And so they were rightfully so concerned as they were aging, whether they had if that was going to happen to them. And I did the trust for them. And they were funding, in my view, like, wow, you're funding your long-term care policy. How can you afford this? I know what their assets were, their income, and everything's possible if you make it a priority. But I didn't understand why they were making that a priority and putting, a significant portion of their savings into funding a long-term care policy. And lo and behold, about 15 years after, she ended up getting brain tumor cancer, and she couldn't work anymore. And then about a couple years later, he started having major heart problems and needed heart surgery. So neither of them could work. And then I saw how they were, taking the benefits of the type of policy that you're talking about, and it literally saved them from being homeless. They had the indemnity one where they were able to use that, still relatively take care of themselves, but they qualified for taking the benefits. And they were able to use that to pay for their mortgage, their insurance, their food. And to this day, they're still, because they funded the policy so well, they're living off of it. And I think of, if somebody had told them, what are you doing? You don't need that. Go into investments, put this in real estate investments. Those are all fine.
Mhm.
But that wouldn't have saved them from being homeless.
Yeah. Yeah.
And so that was my first introduction and a believer
Mhm.
about what that is, how critical it is to have that, in addition to whatever assets you have, because it literally, for many people, saves them from being homeless. Because
Yeah.
it was a real eye opener. And if I get, I get an opportunity for every client when I see their assets, I look at it and say, do you have that? Maybe you should consider that, because if you don't, there's a high probability you're going to use up a lot of your assets in long-term care. And for most people, they could go broke. It's not like most people have unlimited amounts
Right.
to pay for long-term care in addition to their mortgage, their taxes, their insurance, their utilities, their filling, their vehicles. It just piles on, just your regular bills alone.
Mhm.
And so that was my introduction into long-term care, was my clients and husband-wife couple. And I'm grateful because it was a real good education, real life education about something that is so important for everyone when they're doing their financial planning and, of course, their trust planning.
Yeah. That's where the numbers, I do think, understanding it conceptually makes sense. And then, but it does get down the numbers. And there's been times when you're looking through the numbers and there's competing concerns, right?
Yeah.
And so, unfortunately, sometimes, maybe one's health is just uh, real borderline, right? And you start running the numbers and they've waited really long. Maybe they're pushing in their almost 70 or something like that. And so you just got to run through the numbers and understand, is this right for your plan? And so sometimes it's, like I said, maybe better for one than the other, but at least look at it. And then other times it's really kind of it's more kind of a no-brainer. A lot of times you just look at it and go, look, this is, you're putting this in and this is what's coming out. Anytime there's a guarantee there, that's something you want to look at. You want to make sure it's a strong company, right? Anytime somebody uses that word, right? So, but yeah, you got to look at the number, you got to understand it, and you want to make sure there's no kind of gotchas later, right? That's why, like I said, I'm a big fan of asking questions and being able to give answers. And if anyone ever gets annoyed by answering questions, that might be a time to take a pause.
Not to sound dramatic, but I've had clients that got tested when they were trying to get a life insurance with the long-term care rider, and they discovered they had cancer or some disease, and they caught it early.
Right.
It literally saved their lives. Now, temporarily, they can't qualify.
Right.
There's a waiting period now.
Right.
But literally, I've had several of my clients where they went through the initial, what do you call it, underwriting, probably this, just preliminary about their health. And they found out they had prostate cancer. Yeah. And they caught it early,
Right.
and was able to catch it, and it saved their lives. Now, I don't want to be dramatic.
Right.
That test catches things that the regular doctors, because obviously the insurance company, when you go through that, want to make sure they check for everything. Your regular doctor, for those clients, they didn't catch it.
Right. So we're talking about this dude. That was like a 2-minute warning.
Oh, yeah, that's fine.
So the other thing that makes me think about is we're talking about underwriting. There are different policies out there. There's different companies out there, and some just will take on that quote riskier person more than the other and give you decent pricing. And so if something is more life insurance based, that has a certain threshold from an underwriting standpoint. If somebody simply, and I had this happen, it was good timing on this person. They put in money. It was actually out of cash. And it said, it's very simple underwriting. You're filling out 2 pages. That's it. That's pretty much the underwriting process, not super intrusive. I said, and so anyways, you either get a double benefit or a triple benefit. Those are what will happen, or they won't offer you anything.
What does that mean? Double, triple?
So you put in $100,000, you could get it up to $200,000 or $300,000 of benefit out later. So in this person's case, I thought they'd get a double, and then they actually got a triple benefit, and they were a little bit hesitant on the $100,000 and said, "Look, we were thinking we're going to put in 100 so you get 200. Why don't we just do 75 and triple that, 225, right? And so that's what they did. And sure enough, within, I think it was 6 months later, something happened and we were able to turn that benefit on. So, it was kind of good timing. But I say that just to say that if it's something on a quote annuity chassis, their underwriting might be a little less, more assets based. So for a long-term care standpoint, so, don't just think, oh, I can't get it. That's not true. Cancer survivors can. There's certain situations when you can and how long they spend. There's things to it, but it's always worth exploring. And the other thing from an opportunity standpoint, what if somebody has a non-qualified, some of these, non-qualified annuities, they got maybe some life insurance policies that aren't doing that well. It may be super old, tied to a different interest rate environment. And so sometimes people can do a 1035 exchange into something that's more suited for what they need. And so this is something to kind of keep in mind. If you already have something in place, but maybe it's just not where you want it to be today, it might be something your agent can explore to see if there's a way to kind of upgrade that to a different kind of policy.
Yeah, so I've seen a lot of clients where they try to qualify for the long-term care insurance policy and they don't qualify. And the agent and the client just gives up. Like, I don't understand that. Is that the only way? Like, they just start planning.
Right.
And then they just wait out the 2, 3, 4, 5 period. And that makes no sense to me. How can there be only one way to do long-term care planning? And so what are your thoughts on that? Because they just literally stop. Like, why? Why don't you think of other alternatives?
Right.
What are your thoughts on that?
Oh, I think you just need to get an idea of when might they be eligible. And oftentimes they'll tell you. And so we have a pretty good back office that, like, again, we're not beholden to one carrier. And so kind of learned on which carriers, are going to be a better place to go to 12 months from now or 24 months from now. And then we're just doing our part, with our CRM and our follow-up. So making sure that, when we're doing a review or something like that, hey, you remember, this is a long-term care, but I just had someone that was uninsurable for life insurance and young person, right? I think they were in their 30s. And, but they were going to be able to be eligible in a year. And they said, well, Ray, what am I supposed to do with my wife and kid for a year? I can't get life insurance. I'm a sole proprietor. And I said, well, so instead of just giving up, I said, there is something out there that is an accidental death policy. Somebody your age, that's probably almost as likely as a chronic illness, right? So he's able to get something, $500,000 worth of insurance without going through underwriting. So it's kind of guaranteed. And then we just followed up in a year and said, hey, now it's time to see if we can get that life insurance you're looking for. So same thing with long-term care. If you can't get it, maybe you can get it in the future. And if not, that's where it gets back to the planning. What are the assets that you're using and how can you best leverage one of those assets for that potential occurrence?
And can you talk about, I'm curious, the difference between someone like you that is, that knows all the different products, you're not married to only a few, and that's all you present to the client, versus you're able to look at all the products out there and what's best. Yeah. What type of planning difference is that? Obviously, I prefer the latter that you do.
Right.
But, people need to know the difference.
Right. Yeah. So as a certified financial planner, I try to get everybody some kind of a plan in place, right? Sometimes it's a situation where we have a snapshot of where you're at, right? With assets and cash flow and liabilities, all those fun things. And some people want a nice detailed plan. Some do not. But in those plans, we're always trying to find solutions in that. Now, so when it comes to our team, we're always looking at ways to come up with solutions. So if it's investment related, right, we have a team in place for that. When it comes to insurance, we've got really strong back offices. I'm looking at it from a planning perspective. What are the things that need to happen for this person to make improvements today? What kind of actions can we do right now to improve this person's plan? Whether it's tax efficiency, investments, risk, all those fun things. And then we try to prioritize it, right? So some things are more time sensitive than others. So we're going to prioritize from an implementation standpoint. Let's go ahead and tackle this, right? So that might be insurance related. It may not be. It may be, if they're coming up on a tax deadline or something like that, it could be, something that has to do with a tax account. So that's really what we do. And always like to kind of narrow it down. So we're doing our due diligence, looking at, the whole gamut, if you will. But then when we're in front of somebody, what they don't want is like, can we evaluate 6 plans in front of me?
Yeah.
That person is zoning out fast. So probably going to go over 2 that we've done our due diligence on, the 2 best solutions. Maybe a third, but usually it's 2. And sometimes it's a close, neck and neck kind of race. Other times I'm like, here's 2, but this is why this one's probably better. But in case this happens, you always have a contingency. Then this plan B over here is going to be okay. So that's usually what we do.
Now I have children from my clients coming in,
Yeah.
and their planning is a little different. So what does that look like for you when you've got, kids that are in their 30s, they're well into their career, they're starting to have children? What kind of financial planning does that look like?
Right. So the good news when somebody's in their 30s and 40s is time is on their side usually. So that's a really big component. And so we got to look and see, well, are they at an employer? What are those employer benefits? Are they doing are they kind of maximizing those out? There are times when somebody might have high income, but maybe they have debts. Maybe they haven't accumulated a whole lot of assets. And so that person might be a little more interested in pay for a financial plan, right? Somebody that can kind of be on their side and help them start to build. And so a lot of times it's just really educational when it comes to folks that are in their 30s and 40s, but try to get them kind of encouraged that, with just a little bit more put away, right? And then sometimes we got to look at their investment strategies. We got to look at that and see, is it the right risk level? Sometimes it's too conservative. It can be people in their 30s and 40s and they get, maybe too conservative. So you just have to look at it. And obviously liquidity is important. So that's when I see folks that they may have already gotten into something and they can't afford to keep it. So that's unfortunate, that's happened. So from a recommendation standpoint, we're always trying to look at, liquidity is important and trying to educate them the differences on, for example, well, what about a Roth? Like they may think they can't get any money out of their Roth before the age of 59 and a half without like a penalty or it being taxable. And that's not always true, right? Your cost basis, not that you want to do that, but a lot of times we're just educating folks on that or this. I got business owners in that age category. And so they may have a solo 401k. And so we're looking at liquidity. Sometimes having that loan provision in their solo 401k isn't the goal. That's not what they want to do, but it might bring them a little peace of mind and it might keep them a little more encouraged to put money there in the first place, knowing that it's not going to be as painful as, a different type of account, that there may be a prepayment penalty or a surrender charge, something like that.
Is there a certain age range where you shift from investment to more long-term care planning or more conservative?
Right.
Or not? Or is it just depends on the person?
I would say it depends on the person, but the reality is, at age 50 and older, we need to at least be planning for aging, right? Just start planning for that and start to explore things from a long-term care standpoint. We'll at least do that. Could somebody do it sooner than that? Sure. But yes, let's say somebody is a business owner and they're in their 30s or even 40s. That's a lot of years of earnings. So that person, especially if they're a business owner, they're probably looking at disability policies, right? Because you got a 1 chance of that happening. And so you want to make sure that you've explored that arena. Is that something that you need? And for some businesses, your physical presence is more important than other types of businesses. So you just have to kind of look and see, what is that? But so for folks that are in their 30s, 40s, that might be a little bigger deal is the disability.
And is a disability just similar underwriting process?
Yeah, no,
No, it's way more stringent.
yeah, a lot harder.
Yeah.
It's financially, there's financial stuff in there too. So it's, and that's got more, there's more details and weeds in that than long-term care policies. But, it's important as an advisor to go over that. And I have a kind of a dedicated person that's on that. So while I understand it, I don't keep up with the, you know, week to week changes that may be in that. So I got a partner in place for that because it's really important that the people that are applying for that, they're getting what they think they're getting. You mentioned caregivers. So for example, one of the policies out there on the disability you can actually trigger a benefit if you're taking care of a family member for long-term care needs. So your disability policy could have not a full benefit, but a partial benefit just because you are showing a loss of income due to you're having to help out a family member, parent, sibling, spouse. So a lot of details there, and then of course some people are like, well, the tax, deduction on it. And then a lot of times they might be told, well, don't you want the tax-free benefit? Maybe you don't do the, tax deduction. Maybe you want the tax-free benefit. Maybe that's more important. So there's a lot there. So that's probably a topic for another episode, but
I didn't think about that for a lot of my clients where they are the universe of their business. And if they become disabled, that's a catastrophe. And yeah, Ray, do you want those?
referrals.
I didn't even think about that for most of my clients are business owners. And, you think about long-term care, but really, like you said, in the 30s and 40s, the likelihood of disability for unemployment, you can't work while you're disabled. That's a higher probability in your 30s and 40s versus the aging process of a long-term care disability. You're right.
Right. And that's what we've done the last year or so is really get more organized, more process driven. So when folks are we really have basically four groups. We got the retired people who are already retired. We got people that are like, I want to be retired. Right. Those are, that keeps us pretty busy. Right. That is too. But we also have the working families. Right. They're working. They have kids. They're still on the payroll, so to speak. Right. But we also have the young professionals. They don't have kids. Maybe they may never have kids. They may not be married. Right. And so, but we have different processes for those four categories. And so that really helps with different kind of strategic partnerships because it's, the conversation with the person that's in their 30s and 40s is not the same conversation when you're in your 50s and 60s. And when you're in your 60s, you've really run out of time to not get it right. You want to get it right when you're there. Whereas in your 30s, maybe a mistake was made, you've got time to recover. But but yes, we love therapy referrals like that as well.
Yeah. And, just to conclude, we've really focused on disability, long-term care and that. So can you just give some idea based on your expertise, what does the future look like in this long-term care, world that you live in,
right?
My clients live in as they age.
Right.
What does that look like in the United States and the products out there in your world?
Right.
How are they going to be able to keep up?
Well, I will say, they had a tough start. We talked about that earlier, long-term care. And I do think that they have done a really good job of starting to price out, quote, products, right, or solutions that people can afford, understand, and get a benefit out. And the companies still be able to make a profit, right? If they don't make a profit, they're not going to be able to pay out benefits to everybody. So I think that is kind of the tightest turn. So now it's about educating folks on it. And again, not everybody needs it. Not everybody can get it, right? So I think that's happening. Now, the other thing that's interesting is, this is another topic for another day, is, what on at the state level, right? So, you're getting, like state of Washington, for example, is kind of getting in the mix. And so I don't know how that's going to play out. Is that something that the government gets involved and it ends up being a benefit for all? Does it end up being something that can't be sustainable for the long term? I'm not really sure how that's going to play out, but it's something that once it's happened, in one place, it's probably going to happen in a couple other states.
Yeah, and I think for the audience that doesn't know what's happening in a few of the states like Washington, the states have to get involved because Medicaid is unsustainable. You have a lot of people walking around with no long-term care planning. And Medicare obviously does not pay for long-term care, maybe just a few days. So the state of Washington taxes, you have to tax the people.
Yeah.
Right? And they're taxing people that are working.
Right.
And if you don't have long-term care policy, they're taxing you. And the benefits that you get is like 3 months, your whole lifetime. Like that's nothing.
Right.
Like, if you're the working people and you're not disabled, you got to pay your whole life while you're in the state of Washington in your payroll tax.
Yeah.
So that is absolutely insane. The taxes are small enough where people are not like, doing a revolution. But the point is if you've been living in the state of Washington for 30 years and then you become disabled and you don't have a long-term care policy, you get 3 months.
Right.
You got to go get your policy.
Yeah.
And in some states, California is going to pass it. New York will eventually have to do it. But most states, it's a financial crisis that the state has to eventually address.
Right.
And in California, which will eventually pass, they won't probably even give you time. Because in the state of Washington, when that happened, all the insurance companies shut down. They said, we're not taking your people. Because you got a flood of people that all of a sudden, oh, now I'm going to go get it.
Right.
Right. And they were like, no, we can't. It's shut down. So you had to now pay out of your payroll tax. And California, I'm sure the insurance company will do the same, where a lot of people now decide, oh, now I want long-term care insurance because I don't want to pay taxes. And same thing. I don't know with all the other states. I guess they're watching to see. But I do anticipate in 10, 20 years from now, these states have to address it. It's just one of those things, what you call the elephant in the room, that most people are underinsured, just like cars.
Right.
And eventually the state has to make up for that.
Right.
And it's unsustainable unless you start taxing the people that are not getting sufficient insurance for that. So I'm glad you brought that up because it is the elephant in the room in every state.
Right.
And it's eventually going to have to be addressed. Legislation will have to be passed for people that are not going to make sure that they're properly insured for the long-term care. So thank you, Ray. This was fascinating as usual. There are 1,000 topics we could talk about for hours.
Right.
But I'm glad we got to address at least one topic.
Yeah. No, I think we covered multiple topics, and I appreciate you being the guest here today on Financially Fluent, and hope to have you return as a guest in the future.
I hope you ask me.
All right.
Thank you.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.